The stock market just hit another record high again. The S&P 500 was up about 30 basis points or 0.3%, the Nasdaq up 0.1%, and the Dow Jones jumping 463 points, closing in on its record all-time high. Now, while these numbers aren't earth-shattering moves, there's something we need to consider here. We're talking about new records on top of Tuesday's records, back-to-back all-time highs. The S&P 500 is now up nearly 10% for the year and 30% from its April 8th lows. That was right after Trump rolled out his Liberation Day tariffs, that policy that a lot of people thought was going to completely crash and sink the market. Instead, the complete opposite happened, and it's just been rallying ever since. And why are markets running the way they have been? While the economy is showing signs of slowing, we've got weaker consumer spending, rising inflation, and the risk of stagflation, which all of that is an ugly mix of high prices and low growth, which historically stagflation crushes stocks. Yet here we are breaking records after records after records. It's just been back to back to back. The answer lies in the rate cut expectations, as investors are betting that the Federal Reserve will cut rates here pretty soon. So maybe even by a bigger margin than a lot of people are expecting, but right now 93.7% chance of a 25 basis point cut, or a 0.25% off of where we are. We'll talk about who's calling for a 0.5% off the Fed funds rate, but we'll get there in a minute. But lower rates mean cheaper borrowing, higher valuations for stocks, and more incentive for investors to continue piling into these risk-on assets like stocks, like crypto, businesses. It's a good time. Normally, high inflation and massive government spending would send long-term bond yields higher, but that hasn't happened. The One Big Beautiful Bill Act, that tax and spending bill, yes, that's the real name, the One Big Beautiful Bill, is a Republican-led package with heavy tax cuts and spending that the CBO says will push the U.S. debt to $40 trillion by 2030. Yet bonds aren't necessarily panicking yet. And in fact, this one was interesting. So if we go back to Webull real quick and you look at this bottom right chart, that is the VIX, Wall Street's fear gauge. And that just hit new lows for the year, closing in at around 14.73. And that's the lowest since late 2023. And here's the translation for you. The market isn't necessarily pricing in fear right now. It's pricing in optimism, if anything. Now, here's why the Fed's next move matters. The July CPI report showed inflation holding steady, not necessarily falling, but not alarmingly rising. And that was enough to fuel bets that the Federal Reserve will cut rates in September. We just looked at the rates. And right here, what we see is Scott Bessent, Treasury Secretary, even floated the idea of 50 basis point rate cut, or 0.5% off of the Fed funds rate from where we are right now at the September meeting, and suggested we should be 150 to 175 basis points lower overall. And remember, 150 basis points, that's 1.5% lower than where we are right now. And if this happens, we could be looking at one of the most aggressive easing cycles in years. But here's the catch. Not everyone's on the same board at the Fed. The split inside the Fed is something we should talk about, because we've mentioned some of these hawks who don't necessarily support cutting rates, and we got another one today who is Chicago Fed President Austin Goolsbee, who flagged one of the most concerning trends in the July CPI report. So he was pointing out the service sector inflation and how it was ticking up. And why is this one a big deal, Mr. Goolsbee? Because service inflation tends to be sticky. It's not like a one-off spike in goods prices from tariffs, if they show up or not. It's tied to wages, rents, healthcare, the kind of stuff that doesn't necessarily go down easily or just disappear out of thin air. And here's the historical context. The Fed has a much harder time bringing inflation back down when services lead the charge, and that's why Goolsbee says he's uneasy about assuming tariff-driven goods inflation is a one-and-done event. Now, the other issue we should consider is that tariffs aren't all hitting at once. They're being phased in at different products. especially intermediate goods like semiconductors. And what that means is that inflationary pressures could keep trickling up over the coming months, and not just in one spike. And this staggered effect makes it harder for the Fed to look through the data and necessarily say what they want to do. So they can't just say, we'll ignore it, it's temporary, because it's uncertain, like it's always been. So right now, traders are making a bet that the Fed will prioritize growth and jobs over hitting their 2% inflation target, their dual mandate. So it's either 2% inflation or maximum sustainable employment growth, or a stable jobs market. They're saying that the Fed might bring their attention from this inflationary target that has pretty much been the topic of discussion for the last few years, and more so to the jobs market. And that BLS jobs report that we got a couple weeks ago on that Friday really brought alarms to it. So if they're right and we get multiple rate cuts, stocks could keep running higher, at least in the short term. We don't know where we could possibly go after that, because some people argue that stocks are pretty extended, but if service inflation sticks around and proves to be sticky and forces the Fed to hold the line, that's when this rally could hit the wall. So the main takeaway here is that we're in this rare moment. It seems like we're always in this rare one-off moment where stocks, bonds, volatility, all are sending the same message. We believe in the Fed's safety net, but history says safety nets can disappear very quickly when inflation doesn't behave. So as an investor, or even as someone just trying to read the tea leaves of the economy, you've got to ask yourself, are we in the early innings of a new bull market fueled by easy money, or are we dancing right before the music stops? Because right now the market's not just betting on the Fed cutting rates. It's betting the Fed won't get cold feet. So keep on tuning in, y'all. We'll keep on covering. I feel terrible. I'm about to go to bed. My bed is soaked, and I'm soaked right now, running a fever and trying to get better. So the market's definitely doing better than I am today. Hopefully y'all are feeling good. I'll see y'all tomorrow.